Many times we come across fancy investment ideas in TV shows, movies or advertisements where the protagonist earns massive returns from stock market. However, this is not how things work in reality.
You've been living in a dream world.
Investing can be very complicated and confusing, but it also can be very simple. You need to have discipline and should adhere by some basic rules for successful investing in real life, especially during times of recession.
Investors have to be able to detach themselves from those emotionally and temperamentally from that tendency to go along with crowd behavior.
First rule: avoid stocks that gets the most publicity. There's nothing wrong with getting investment ideas from friends or the internet and even social media. After all, great companies often start small, and you're unlikely to find them on the front page of a national newspaper. However, as an investor you should be asking yourself questions like, is this company a good long-term home for my money? Is the business strong enough that I'd be happy to hold it for years if the share price fell tomorrow? Do I think it'll grow its profits in the future? Does the share price reflect that growth potential? If the answer to these sorts of questions is no, as an investor you should not consider investing in that business, regardless of what the share price might do tomorrow. Make a little bit of a research before putting your money into a business. Most people, before buying a phone, they will make a research, look for the phone with the best camera, the one with the maximum storage space. But when it comes to investing, they just buy companies because their bishop in church is recommending it.
I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "Well," he said, "you can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know."
On One Up on Wall Street, Peter Lynch said, "If I could avoid a single stock, it would be the hottest stock in the hottest industry, the one that gets the most favorable publicity, the one that every investor hears about in the carpool or on the commuter train, and succumbing to the social pressure." He also said, "Another stock I'd avoid is a stock in a company that's been touted as the next IBM, the next McDonald's, the next Intel, or the next Disney. In my experience, the next of something almost never is."
Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike.
Second rule: do not buy and sell based on price. If all you know about a stock is its price, you might and probably will make investing mistakes. If a stock has had a good run-up, it might be time to sell, not buy, because you want to sell high and reinvest those gains in undervalued stocks. If a stock has dropped like a rock, it might be a good time to increase your holdings, because the price is liable to rise again once the market settles. You won't know what to do unless you understand and know a lot more about the company than just its stock price. What's important in the long run is a company's fundamentals. Those will always outlast any irrational investor behavior.
There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Research and analysis lies at the base of investing. The smart trader will tell you that you don't need to spend time on fundamentals. The market is normally smart, and the best you can do is to identify trends using technical. There are also traders who purely trade on news flows. Then why are fundamentals so important? That is because the best way to find an underpriced investment is by understanding the financial and non-financial contours of the company. Only then can you have a reasonable value imputation done and take an investment decision accordingly. Warren Buffett says there's one you should always avoid: buying a stock merely because you think it's going to increase in price. That's because even the best investors aren't able to predict how the market will perform. Instead, you should invest in companies that you both understand and believe will offer long-term value.
If you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise and you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about, whether we have new competition, how we do over the years, but it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do?
Third rule: don't let emotions control your investments. There's no denying it. Investing is an emotional experience. After all, it's your money and your financial future we're talking about. But keeping your emotions in check and staying focused on a plan that's geared toward your goals and risk tolerance can be essential to your long-term investing success. Going through this cycle of emotions is only natural. The challenge is how you react to the peaks and valleys, especially when the market dips a lot. Consider the following. When markets are up and life is good, you might ask yourself, should I invest more? So, it's also helpful to think about the reverse scenario. During the capitulation stage, when markets are down, you might ask yourself, should I cut my losses and sell? It's human nature to want to take action, but if you sell, you'll be faced with a much different reality when markets eventually recover and when optimism than euphoria reappears. In short, by removing yourself from the market, you risk losing out on the market recovery and positive gains.
You don't need a lot of brains in this business. I mean, I've always said if you got an IQ of 160, give away 30 points to somebody else because you don't need it in investments. What you do need is emotional stability.
The true test isn't finding the best time to buy or sell. It's finding a way to look past the media headlines, push aside your instincts to act suddenly or emotionally, and stay true to your reasons for investing in the first place. Then, you can let the natural market cycle take care of the rest. Investing can be complex, but some of the most important habits of successful investors are pretty simple. Like Warren Buffett, he clearly does not invest in businesses he doesn't understand. He's one of the investors that we need to emulate, and most investors can learn a lot from him. To see how Warren Buffett remained disciplined throughout his investing life, check out the video in the end screen.